Hello, everyone, and welcome to this episode of our podcast on the role of intangible assets in transfer pricing comparability. I'm your host, CA Gaurav Garg, and I'm happy to be here again with my team member, CA Preksha Gupta.
Thanks, Gaurav. Transfer pricing is quite a complex subject, and I am sure our audience will gain good clarity from today's discussion on the issue relating to the significance of intangible assets during comparability analysis in a transfer pricing exercise. To begin with, Gaurav, can you explain the role intangible assets play in transfer pricing analysis?
Certainly, Preksha, intangible assets such as patent, trademark, and trade secrets are often a critical factor in transfer pricing analysis. They provide a competitive advantage and significantly influences a company's valuation and revenue generation. And I often say, Ram se bada Ram ka naam. Their impact on profitability makes them an important factor to consider while doing comparability analysis during transfer pricing exercise.
Could you elaborate on the key factors for determining the arm's length price in control transactions under Indian transfer pricing rules?
Sure, Indian transfer pricing rules, specifically Rule 10b-2 of the Income Tax Rules 1962, outlines several factors. These includes the specific characteristics of the property or services transferred, functions performed considering asset employed and risk assumed, popularly known as FAR analysis, contractual terms defining responsibilities and benefits between the parties, market conditions like geography, labor cost, economic development, and competition levels. Importantly, Preksha, Rule 10b-2b emphasizes the role of asset employed. And we all know asset includes intangible assets too.
Okay. And we have seen companies with high intangible assets often pose challenges as comparables, especially for captive service providers. Why is that?
Yes, Preksha, you must have seen the showcase notices that we receive. You will often find that companies with high intangibles are generally favorite to the transfer pricing officers. Companies with significant intangible usually have higher operating margins because their IP adds substantial value. This can distort benchmarking analysis for captive service providers, which generally perform routine functions and bear minimal risks. We have seen that including such companies as comparables inflates benchmark range and median, creating transfer pricing addition for captive or routine service provider.
True. Are there some judicial precedents where companies with high intangible assets were rejected as comparables for captive service providers?
Yes, there are a plethora of judgments on this matter, quoting few. The Honorable Delhi High Court in the matter of Symphony Marketing Solutions India Private Limited excluded Infosys BPO due to its substantial goodwill, brand promotion expenses, and significant selling cost. Similarly, Punjab and Haryana High Court in the matter of Comverse Network Systems Private Limited rejected Infosys and Celestial Labs because of their IP ownership, R&D expenses, and diversified business models. And there are other cases as well. One can refer to Delhi High Court judgment in the matter of Open Solutions Software Services Limited, then Mumbai Tribunal in the matter of Capgemini India Private Limited, Bangalore Tribunal in the matter of Integral India Software Development.
Nice. But has there been a case where a company with intangibles was retained as a valid comparable?
Yes, the Bundy India Limited case is one example, wherein the Ahmedabad Tribunal noted that intangibles alone don't automatically disqualify a comparable. It must be proven that intangibles significantly affect margins. In this case, the SSC could not demonstrate such an impact and the comparable was retained.
Okay. Finally, Gaurav, what is the key takeaway from judicial precedents regarding intangible assets in transfer pricing?
See, judicial precedents highlight that while intangible assets are critical factor, their presence does not automatically disqualify a company as comparable. A thorough assessment of how they impact margins and economic profiles is essential. Comparables must align closely with the tested party to ensure fairness and compliance.
Thank you, Gaurav, for such a comprehensive discussion. I'm sure our listeners have gained valuable insights into transfer pricing and the role of intangible assets while doing benchmarking analysis.
Thank you, Preksha. It has been a pleasure discussing this with you, and I hope this helps our listeners.
Absolutely. And to our audience, if you enjoyed this discussion, don't forget to like, share, and subscribe our YouTube channel for more insightful content. Until next time, stay informed and stay compliant.
Bye bye.
Bye bye.